The $20,000 retirement income strategy. How low-cost planning changes the math. A quick note before we continue. Ads may play during this video. Your support keeps this content free. Now let's jump in. Within the next 24 months, a silent redistribution of wealth is going to strip millions of high net worth American retirees of their financial autonomy. While the conventional wisdom suggests you need a $3 million nest egg to survive, the reality is that the Internal Revenue Service and the Medicare system have built a series of invisible tax cliffs designed specifically to penalize those who have been successful. If you are sitting on a significant 401k or a traditional IRA, you aren't just holding a retirement account, you are holding a massive, growing liability for the federal government. What if I told you that the ultimate secret to long-term capital preservation isn't having more money, but rather mastering the art of living on a strategically low taxable income? Imagine maintaining a luxury lifestyle while showing the government a taxable profile of just $20,000. This is not about deprivation. It is about sophisticated capital allocation and liquidity management. By the end of this video, you will understand how institutional investors use asset-based lending and strategic Roth conversions to bypass the success taxes that drain the portfolios of the uninformed. If you don't understand how to manipulate your adjusted gross income, you are essentially volunteering to pay for the same healthcare and the same lifestyle at a 300% markup. The problem facing today's professionals and business owners is that they have spent decades in the accumulation phase, focusing entirely on the gross size of their balance sheet. However, as we enter 2026, the rules of the distribution phase have fundamentally shifted. We are now seeing the implementation of the One Big Beautiful Bill Act, which has introduced a massive new $12,000 deduction for married seniors over 65. While this sounds like a gift, it is actually a diagnostic tool for the IRS to identify who is and isn't managing their tax brackets effectively. If your taxable income exceeds certain thresholds, you hit the dreaded Medicare IRMAA surcharges. For a retired couple in 2026, crossing the income line of $218,000 triggers a cliff where your monthly Part B and Part D premiums skyrocket by thousands of dollars a year. This is money that provides you with no extra benefit. It is a penalty for inefficient capital allocation. Why would you allow your hard-earned liquidity to be siphoned off just because you didn't know how to structure your withdrawals? To master the $20,000 income strategy, we must first look at the three-bucket system of tax diversification. Most people have their wealth concentrated in bucket 1, which is pre-tax money like 401ks and traditional IRAs. This is the most dangerous place to be because every dollar you withdraw is taxed as ordinary income at the highest marginal rates. To live on $20,000 effectively, you must aggressively build Bucket 2, which is your Roth and tax-free accounts, and Bucket 3, which is your taxable brokerage accounts. The goal is to use the standard deduction, which for a married couple in 2026 is $32,200, plus the new $12,000 senior deduction. This means you can have $44,200 in taxable income and pay zero federal income tax. By reporting only $20,000, you are leaving a massive tax-free buffer that allows you to harvest long-term capital gains at a 0% rate. The second pillar of this strategy involves institutional-level liquidity management through asset-based lending. For many business owners, their wealth is tied up in a liquid equity or massive stock portfolios. Rather than selling these assets and triggering a capital gains event that could push you into a higher tax bracket, sophisticated investors use a securities-based line of credit or an SBLOC. This allows you to borrow against your portfolio at prime rates. Because a loan is not considered income by the IRS, you can draw $50,000 for a Mediterranean cruise or a new vehicle, and your reported income remains at $20,000. You aren't earning an income, you are managing a liability. This keeps your adjusted gross income low, protects your Medicare premiums from IRMAA surcharges, and allows your primary assets to continue compounding untouched by the taxman. This is how you maintain a high-volume market presence without the high-volume tax bill. The third pillar is the aggressive management of your required minimum distributions, or RMDs. If you leave your traditional IRA to grow indefinitely, the IRS will eventually force you to take distributions that could easily push you into the 32% or 35% tax brackets. To live on $20,000 effectively, you must engage in bracket-topping Roth conversions today. By converting small portions of your traditional IRA to a Roth IRA while you are in a lower bracket, you are effectively buying tax insurance. You pay a small amount now to ensure that when you are 80, you can withdraw $500,000 tax-free. This is the essence of estate planning and wealth building. You are removing the government as a silent partner in your retirement accounts and ensuring that your heirs receive a tax-free windfall instead of a tax-burdened headache. Let's look at the actual numbers for a married couple in 2026. If you have $2 million in a brokerage account and $1 million in a 401k, the average person might take $80,000 from the 401k to live. They will pay federal tax, state tax, and potentially trigger higher Medicare costs. However, using our strategy, that same couple could take $20,000 from the 401k, utilize their $44,000 deduction to pay zero tax, and then take another $60,000 from their brokerage account. Because their taxable income is so low that $60,000 in long-term capital gains qualifies for the 0% tax rate. They have $80,000 in their pocket, but their tax bill is zero, and they are completely immune to Medicare surcharges. This is the power of being a knowledgeable authority in your own financial life. We must also discuss the provisional income trap related to Social Security. For many retirees, Social Security is a significant portion of their cash flow. However, if your other income is too high, up to 85% of those benefits become taxable. By keeping your reported income at $20,000, you are shielding your Social Security benefits from this double taxation. You are effectively increasing your internal rate of return on your Social Security just by being smarter about where you pull your other dollars from. This is a form of risk management that the general public rarely considers because they are too focused on the stock market and not focused enough on the tax market. For business owners and professionals with high lifetime value, the $20,000 strategy also opens the door to significant estate planning advantages. When you maintain a low income and use asset-based lending, you are preserving the principal of your assets. When you pass away, your heirs receive a step-up in basis to the current market value. This means that decades of growth can be passed on completely free of capital gains tax. If you had sold those assets during your life to fund your retirement, you would have paid 20% to the government. By borrowing against them and living on a low reported income, you have effectively bypassed the capital gains tax system entirely. This is how dynasties are built, not by earning more, but by keeping the government out of the chain of custody. One of the most common objections I hear is, won't a low income make it harder to get a loan or a mortgage? This is where the institutional shift in lending comes into play. Modern lenders are moving toward asset depletion underwriting and net worth lending. They care far more about the $10 million you have in liquid assets than the $20,000 you show on your tax return. In fact, many high net worth individuals find that having a low income actually makes them a more attractive borrower because it demonstrates a level of financial sophistication and tax efficiency that correlates with lower default risks. You are moving from a W-2 mindset to a balance sheet mindset. Another critical component of this strategy is the use of qualified charitable distributions, or QCDs. Once you reach age 70 and a half, you can send up to $115,000 directly from your IRA to a charity. This distribution satisfies your RMD, but is not included in your adjusted gross income. If you are already charitably inclined, this is the ultimate tax hack. Instead of taking the money, paying the tax, and then taking a deduction, you simply erase the income from the books entirely. This keeps your income at that magical $20,000 level, preserving your eligibility for various subsidies and keeping your Medicare costs at the baseline. To begin implementing this, your first action step is to perform a tax liability audit. You need to know the exact tax status of every dollar in your portfolio. If you are tax-heavy in pre-tax accounts, you need to start a 5 to 10-year Roth conversion plan immediately. Second, you need to establish your liquidity buffer. This is usually 6 to 12 months of cash in a high-yield account or a dedicated line of credit that you can tap into without selling assets. Third, you should consult with a fiduciary who specializes in forward-looking tax planning rather than just backward-looking tax preparation. You need a strategist, not just a historian. In 2026, the cost of being uninformed is higher than ever before. With the sunsetting of various tax provisions on the horizon, the windows for these strategies are closing. You must be proactive in your capital allocation and wealth management. The goal of this channel is to provide you with the high-bid lexicon and institutional strategies that the big banks use for their private clients, but made accessible for you. We upload fresh videos on these advanced financial strategies regularly to ensure you stay ahead of the IRS and the shifting economic landscape. In summary, the $20,000 income strategy is the ultimate defensive play for the affluent. It protects you from Medicare cliffs, shields your Social Security, optimizes your estate planning, and allows you to live a high-quality life on your own terms. It is about understanding that in the eyes of the government, what you earn is a matter of record, but what you report is a matter of strategy. By mastering the art of the low-income wealthy, you are ensuring that your retirement is defined by freedom, not by a series of mandatory payments to the state. If you found this deep dive into institutional tax efficiency and liquidity management valuable, please click the thumbs up button to give us a like as a thank you for this content. It helps our algorithm find more savvy investors like yourself. Please subscribe to the channel so as not to miss our future sessions on wealth building, asset protection, and estate planning. I would also love to hear from you in the comments. Share one idea from this video that you plan to discuss with your financial advisor, or ask a question about your specific retirement bucket strategy. Your engagement is what allows us to keep providing this high-level analysis. Finally, a necessary disclaimer. I am not your financial advisor. The information in this video is for educational purposes and should not be taken as individual financial or tax advice. Tax laws are incredibly complex and subject to change, especially with new legislation like the One Big Beautiful Bill Act. You should always seek professional advice from a qualified fiduciary, CPA, or tax attorney before making significant changes to your portfolio or income strategy. Your financial security is a lifelong project, and having the right professional team is the most important investment you can make. Keep compounding your knowledge, stay disciplined with your capital allocation, and protect the legacy you've worked so hard to build. Would you like me to create a dedicated video on the specific 2026 Medicare IRMAA appeal process for those experiencing a life-changing event?